The Reserve Bank of New Zealand today raised interest rates by 0.25% to 5.5%. Now, this is the smallest rate rise since January last year. In its statement, the RBNZ pointed to more rate rises, though, saying overall, high interest rates are still needed to further slow demand. This will help reduce upward pressure on prices, leading to lower headline inflation. And Nick Tuffley is the Chief Economist of the ASB Bank, owned by the Commonwealth Bank, and joins me now from Auckland. Nick, many thanks for your time. I just wonder here, with a cash rate of 5.5%, in Australia it's 3.85%, people are whinging like nobody's business here. Do you reckon they might be a bit soft compared with the Kiwis?
Well, look, I think we're all feeling similar sorts of pressures. I think in a New Zealand context, inflation is a bit more persistent, but the big thing is those interest rate increases. So substantially more in New Zealand, and we still haven't felt the full effects yet because there's a tendency for people to fix their mortgage in New Zealand. So we're still going to have more people rolling onto higher interest rates over the rest of this year. So look, it's pretty tough.
But I've got to say, it's been a really aggressive rate rise strategy by the RBNZ. They have not relented. They have kept their foot on the pedal pretty much all the way through. This is the first time they've just eased back from those 0.75% or 0.5% rate rises. Do we read too much into that?
Look, I think from the Reserve Bank's statement today is that they do think they have done enough now, and it's just a matter of waiting and seeing and checking the data to make sure. So they are conscious that they need to hold interest rates up at a pretty high level for some time just to keep getting inflation down. But they've got more confidence. We're seeing signs inflation is turning, inflation expectations are down. Activity is certainly cooling off. We've had 6 months of retail sales volumes contracting as one example. And the housing market, although it could be bottoming out soon, we've seen 16-17% overall decline in prices since late 2021.
And just tell me, as you're a chief economist, you try and gauge the public mood there. What's it like? Is life tough? Is it difficult, or is there still plenty of money sloshing around in that economy?
To some extent, it's been surprising how resilient the economy was last year, but I think things are just starting to catch up with people now. So there is a lot of focus on the cost of living. The food prices have been going up 12% over the last year. That's really challenging for low-income people. And we're starting to see those signs now that interest rates are really biting. So it's really chewing into discretionary spending now. And so the cracks are starting to show a little bit, as you'd expect after 18 months of interest rate increases.
So the monetary policy statement also came out today, and did they change the forecast for the future, the economic growth forecast for New Zealand?
Well, the key thing is that the inflation outlook hasn't really changed. If anything, it's been shaved down the odd 0.1% here and there. And the Reserve Bank's forecasts of the official cash rate, where it thinks it needs to set the cash rate, actually remain pretty steady at 5.5%, which is where we are now. So they are really signalling we're pretty much done now. They've acknowledged that last year the economy was a bit weaker than what it had expected, particularly at the end of last year. But we've got things like a more stimulatory budget. We've got some disaster recovery spending, which is probably helping prop growth up a little more than what they would have thought, say, late last year.
Yeah, I was going to say that budget was certainly stimulatory. Many people thought it might have been adding to inflation and adding to the task of the Reserve Bank.
Yes, look, we certainly thought that was the case. A lot of the fiscal stimulus is sort of really hitting over the next year, which is when the Reserve Bank is trying to pull things in the other direction. But the Reserve Bank seemed to downplay the impact of the budget. And it's also been quite nuanced on migration. We've had a very strong surge in immigration. There was a bit of concern leading into the statement that the Reserve Bank might be emphasising the demand impacts, the inflationary impacts of that. And we think the Reserve Bank's taken a pretty sensible stance. They've gone, look, it's uncertain. They're noting that the labour supply is really increasing as a result of that migration. So they've been prepared to take a bit of a back seat and just really see what happens in terms of softer wage growth versus what might happen on the added spending we get from just simply more people being here.